K. Demonstrate understanding of independent checks and verification. Independent checks provide objective validation of transactions and balances. They involve review by individuals not directly responsible for the original transaction, increasing reliability and reducing bias. Examples include supervisory reviews, internal audits, and reconciliations. Verification enhances error and fraud detection. By comparing source documents, physical counts, and accounting records, organizations can identify discrepancies and correct them promptly before financial statements are issued. Regular and systematic reviews strengthen accountability. Independent checks reinforce compliance with policies, promote ethical behavior, and improve overall control effectiveness by creating visible oversight mechanisms. L. Identify examples of safeguarding controls. Physical controls protect tangible assets. Locks, safes, security cameras, restricted access areas, and inventory counts help prevent theft and misuse of cash, inventory, and equipment. Technological controls secure digital assets. Password protection, encryption, firewalls, and access controls limit unauthorized system access and protect sensitive financial data. Authorization procedures protect financial integrity. Requiring managerial approval for expenditures, investments, or asset disposals ensures that resources are used appropriately and aligned with organizational objectives. M. Explain how pre-numbered forms and authorization procedures function as controls. Pre-numbered forms create a complete audit trail. Sequential numbering of invoices, checks, and purchase orders ensures that all documents are accounted for and missing items are identified promptly. Document control reduces unauthorized transactions. Specific policies designating who may issue, receive, or approve documents prevent improper access and limit opportunities for fraud. Monitoring sequence integrity enhances reliability. Regular review of numerical sequences helps detect omissions, duplication, or alteration, strengthening transaction completeness and accuracy. N. Define inherent risk, control risk, and detection risk. Inherent risk is the susceptibility to error or fraud without considering controls. It depends on transaction complexity, industry volatility, and judgment requirements. Control risk is the possibility that internal controls fail to prevent or detect misstatements. Weak procedures, poor oversight, or inadequate segregation increase control risk. Detection risk is the chance that audit procedures fail to uncover existing misstatements. It relates to audit effectiveness and testing adequacy, influencing overall audit risk assessment. O. Distinguish between preventive and detective controls. Preventive controls aim to stop errors or fraud before occurrence. Examples include segregation of duties, authorization requirements, and access restrictions that block improper activities in advance. Detective controls identify issues after they occur. Reconciliations, internal audits, and variance analyses help uncover discrepancies and enable corrective action. Both control types are complementary. Effective internal control systems integrate preventive measures to reduce risk and detective measures to ensure timely identification and remediation of problems. P. Describe the major internal control provisions of the Sarbanes-Oxley Act, SOX. Section 302 requires executive certification. The CEO and CFO must certify the accuracy of financial statements and the effectiveness of internal controls, increasing accountability at the highest management level. Section 404 mandates internal control assessment and reporting. Management must evaluate and report on the effectiveness of internal control over financial reporting, ICFR, and external auditors must attest to management's assessment for public companies. SOX strengthens audit committee independence and oversight. It requires independent audit committees responsible for hiring and supervising external auditors, reducing conflicts of interest and enhancing transparency in financial reporting. Q. Identify the role of the Public Company Accounting Oversight Board, PCAB. The PCAB oversees audits of public companies. It establishes auditing standards, conducts inspections of registered public accounting firms, and enforces compliance to protect investors and ensure reliable financial reporting. T provides guidance on auditing internal controls. The PCAB issues standards that define procedures auditors must follow when evaluating internal control over financial reporting under SOX Section 404. IT enhances audit quality and independence. Through inspections and disciplinary authority, the PCAB promotes accountability among audit firms and improves confidence in the auditing process.